When traders talk about passing a prop firm evaluation, they often look for a special indicator or a perfect setup. My experience was less glamorous, and a lot more useful. I used a trend-following process, and what made it work was not prediction. It was process, patience, and accepting that uncertainty has to be managed, not eliminated. The FTMO challenge and verification reward consistency more than drama. That is exactly why trend following fits. It accepts a low win rate, it expects small losses, and it relies on a strong reward-to-risk profile to carry the account over time. In that environment, the real edge is not being right often. The edge is being disciplined enough to keep showing up the same way. The first lesson was position sizing. If you are not sizing trades according to rules, you are not really executing a system. You are improvising. Trend following can survive a streak of small losses, because that is built into the design. But if the size is too large, those normal losses become emotionally expensive and financially disruptive before the bigger move ever has room to develop. The trade has to be small enough that a stop loss, or even a bad market regime, does not distort your judgment. The goal is not to be right on every trade. The goal is to make sure one wrong trade does not damage your ability to keep trading correctly. The second lesson was hunting for the right position. Trend following is selective by nature. It does not ask you to trade constantly. It asks you to wait for a market condition where the trend has room to develop and the risk can be defined clearly. That selectivity matters more than people admit. Many traders feel productive when they are active, but activity can be a form of self-deception. The right trade is usually the one that matches the regime, the structure, and the edge. The wrong trade may look reasonable in the moment, but it tends to cost time, energy, and confidence. Fewer decisions also means fewer mistakes. The third lesson was staying in the trade long enough for the edge to express itself. A lot of traders can enter a trend. Far fewer can sit through the uncomfortable middle of it. That is where the money is often made, and also where discipline gets tested. Early profit has a way of making itself feel sufficient. That is when the urge to take profit too soon shows up. But trend following depends on letting winners run while managing risk on the way. That does not mean being passive. It means managing intelligently. If the market structure supports continuation, the trade deserves room. If the trend weakens, then scale out or exit rules should protect capital. Control comes from process, not from constant intervention. The uncomfortable part for many traders is the low win rate. But low win rate is not automatically a flaw. In trend following, it is often the cost of accessing asymmetric payoffs. You accept many small losses so that the rare, larger move can carry the account forward. That is why the equity curve often looks like a steady upward drift with frequent setbacks and occasional larger gains. Day to day, that can feel unpleasant. But mathematically, it can be rational and robust. The trade duration point matters too. In my sample, the longest holding trades, extending beyond 12 hours, were the ones that produced most of the profit. That is not unusual in trend following. The extended hold, not the frequent scalp, often pays for the whole sequence of attempts. So the real job is not to overmanage the move that is actually working. What helped me pass the FTMO challenge and verification was not certainty. It was acceptance of uncertainty, with rules that made it manageable. Trend following is not about being clever every moment. It is about being disciplined enough to exploit the moments that matter. And for traders and investors alike, the lesson is simple: control risk, size honestly, and let the winners do the heavy lifting.